Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth. Looking forward to today. It's been a little while since I've been on the show, and so looking forward to it. This is a little bit longer show. So if you remember in January, I did a kickoff report going through what we thought would happen in 24 and what we saw in 23. So we call this our halftime report. So we're going to go through what we kind of thought may have happened this year so far, what's happened, where we see things headed towards the end of this year. It's been a wild year so far with news and elections and what's going on with the presidential race. So, I think we'll have a lot to talk about as we finish out this year. But it's good to reflect back the first 6 months, see where we thought we'd be, where are we, and this it's a good time to do that. So let's dive in, and hope you enjoy. All right, so first things first, let's look at what the economy has reported to us. I normally start these off with the federal budget. You can see here on let me get my little laser pointer. You can see here on your left side of the screen where our spending is going as a country. You can see where our income is coming from, and we're borrowing about $1.9 billion, almost $2 billion, which represents about 28% of our spending. So it keeps getting worse, and we've got doesn't seem to be getting better. Over here on the right, you can see where they think it will go. So if you look at, we're at about 90, almost just call it 100% of GDP in federal net debt. And so we can see that, looks like the trend does not stop by 2034, looking at somewhere around 120 to 130% of GDP. Now, something to be aware of, we have been at this level in the past. You look back during the war, World War II, we were above 100% at that point as we fought the war, as we fought World War II. So we can get out of this, but we cannot keep having this trajectory moving forward. So something everyone understands it. We just got to figure out how to deal with it. So now we're looking at consumer. So we've looked at that. The last slide was the government as a whole, and now we're looking at the American, the people. So these are total assets from all the American households. So you can financial assets, pension funds, deposits, people's homes, and then you can see the debt, which is mostly mortgages. Our household debt ratios are down pretty good. Of course, they fell a good bit there after during the pandemic. People were not spending, all of that. Then it rose back up, actually a little bit on a downward trend here. One of the things we are looking at, I noticed last time we did this, which was in January, we're starting to see more delinquency. So early delinquencies in not student loans, because a lot of those are getting paid off by the government, but we're seeing auto and credit cards. So you're seeing those delinquencies starting to increase as you see your rates on those cards also increase dramatically because of the Fed increasing interest rates. So that has really made a big difference. We're really watching that as that can cause some issues in the economy too, with delinquencies happening on these auto and credit cards. So we look at inflation, still trickling down, kind of where we thought it would be. This shows consumer price index of the last 50 years and core CPI, which excludes food and energy prices, that tend to vary widely, more widely than other prices. But all in all, the slide's just showing that we see inflation continually kind of going down there. And here is our federal funds rate. So we expected at the beginning of the year, this is one where I think a lot of people maybe missed the mark a little bit. So we were expecting at the beginning of the year, some people were expecting 5 or 6 rate cuts. We've yet to see a rate cut yet. Um, Possibly, maybe a small cut towards the end of 24, but we really think that the rate cuts will tick up in 25. But really, this is going to depend on how the market and how the economy, not the market, the economy responds to these rate cuts. If we really get a push when we get a couple of rate cuts and people start really spending money, it's going to drive up inflation, and the Fed's liable to, hold, or they could actually reverse and increase rates again. But this year, it doesn't appear we're going to get, maybe one, possibly two, but it looks like probably one rate cut this year, maybe 1/4%, and then next year that ticking up, and that's what this graph here is showing. But it was wrong this year, so we'll see where that ends up. All right, this is another graph that the economists got wrong, and a lot of this has changed with the Federal Reserve. So, after increasing the balance sheet during the pandemic, which we see, this is the Federal Reserve balance sheet. Okay, so they pumped all this money into the economy, so their balance sheet went up, and then we saw it start to trickle down as they did quantitative tightening. Okay, so they started taking money back out of the economy, but the Fed announced plans to slow the pace of this quantitative tightening, over the summer, and conclude quantitative tightening by the fourth quarter of this year. So that means they're not planning on doing any more quantitative tightening, which is probably setting them up so they can reduce rates. So they're not doing both at the same time. But this is a shift in prediction that we had and what the Fed kind of was alluding to in January of this year. So if you look at the next slide, this was our January prediction. You can see the slope of this, of them continually reducing their balance sheet over the next few years. So you see that. Now see where we are now. It's flattened out, and that's due to the Fed's decision to basically conclude quantitative tightening. I really don't like this. I thought, the good plan forward was to keep quantitative tightening, keep pulling the money out of the economy, but looks like they're going to take a break from that, which is probably going to allow them to decrease rates, and they didn't want to be doing both at the same time. So that, because taking money out of the economy and adjusting rates actually has the same net effect on our economy. So they may have thought it was a little bit too much to be doing both at the same time. So we'll see. All right, let's look at the equity markets. So S&P 500 so far this year, great return. We've had a 13%, a little over 13% year-to-date return. That's a price return. It's a little over 14% if you factor in dividends and total yield. But what a great year in the market, and a lot more than what most people probably would have imagined. We had a little bit of slippage there, going into April, between April and May, but we recovered, and now we're seeing a little bit of pullback right now. So all, very normal ups and downs in the market, but all in all, it's been an unbelievable year so far in the S&P 500, which is, once again, our 500 largest companies in the U.S. So with that upward trend, we continue to see the S&P price to earnings, which is, it evaluates whether the equity markets appear overvalued, and if so, how much. So our 30-year average runs right here. And so if you go back to January, we were at 19.5, and we're up to 21 times earnings right now. So if you were to, make a statement on are the stocks in the S&P overvalued or undervalued, you would probably indicate that they are overvalued at this point based off this chart. And they're up, from January as well, which they would be because the market has steadily increased and we have not gotten as much earnings to offset that price increase. So we'll see where it goes, but right now it looks like the market is overvalued by a decent amount. But this slide here shows a little bit different of a story. We looked at this in January as well. So this is the performance of the Magnificent Seven. So when you look at the S&P 500, the Magnificent Seven, they're calling the largest 7 companies, which is your Apple, Microsoft, Amazon, Google, Meta, which is Facebook, NVIDIA, and Tesla. So if you look at those Magnificent Seven in and of themselves, their return so far is about, 33%. If you add them all up, that's about a 61% share of the return of the S&P so far. If you take the S&P and you take out those 7 stocks, the return of the S&P is about 5%. Okay. Or about 39% of the returns of the S&P 500. So when you look at the overvaluation slide we just saw, okay, you have to also look at what would this be without those 7 in there. So number one, we wouldn't have as much return in your portfolios, but also our valuation or our price to earnings would be a lot lower than it is. So really these seven stocks are making up the majority of the returns, and they're also causing the market to look a little bit overpriced. So we see the same thing that happened in 23, dominated by just a few companies. Something to be excited about that we've got, had the growth, but also be a little bit careful, about not staying diversified, which is what this slide is showing us. This is our quilt chart. We look at it basically every time we do one of these halftime or yearly kickoffs. It shows the different asset classes from large cap and small cap, cash, fixed income, real estate, and where they performed in each given year. And, threaded right through the middle is the hypothetical kind of diversified portfolio composing of different weights of all of these asset classes. So what do we get from this? Stay diversified and try not to get lured in with today's winners because today's winners can be tomorrow's losers as they become way overvalued. So we have to be very careful about that. Something I have not shown in a while is the speedometers. City National Rockdale puts out a really good speedometer. So here's where we were in January of 2024. This January, things were improving. If you'd looked at this 6 months prior to this, there was even a lot more red in this chart. Red is negative. The orangey yellow is more of a neutral, and then positive would be green. But in January, this is what it looked like. And then if you jump ahead today, July, things improving steadily. Global economic outlook improving. U.S. growth prospects remain more positive. Reserve rate cutting cycle is ahead. So things just look a lot better than they were 12 months ago, and our forward-looking economic indicators are pointing to really, really some good solid ground that we can build upon. So, all in all, I'm optimistic about this year. It's been a great returns in the market so far. We do have a lot of headwind when we look at what's happening with the presidential election, how that's going to affect the short run. Normally, presidential elections do not have, huge impacts when you look at the total long run of the 12 months following, but short run can really make a big difference. But like they always say, this time could be different. I hope this helped. This is one of those, a little bit longer. We're running about 15 minutes in this show so far. But I think it's important that we go back and look, what has the market done? What has the economy done? Where do we see moving forward? We're on a good footing. We still have to, the balance sheet that the Fed's holding, a little concerning to me. Our national debt still also a concern, but we can work our way out of those. We have in the past. And we'll see how the next 6 months goes, and we'll do another kickoff in January and see how close we were on these predictions of where we think we'll be. So hope that's helped. Remember, this is not tax advice, investment advice. So please don't take this and try to extract trading recommendations out of this or tax recommendations. This is just a generalization of where we were going into the year and where we are now. So hope that's helped. God bless. Y'all have a great week, and we'll talk to you next week. Take care. Bye-bye.